Welcome to today's Explainer. We've got a lot of ground to cover, so we're jumping right into a high-octane digest of all the overnight macro data and tactical levels you need for today's trading session. Look, if you're navigating these crazy volatile markets right now, you need the numbers, the catalysts, and the levels, and you need them fast. So let's dive right in. Here is exactly what's on the docket today. We'll kick off with an overnight global macro wrap. Take a look at shifting global data, break down the technical views for major currencies, and finish up with a deep dive into India markets. Starting things off with Section 1, our overnight global macro wrap. So the Middle East is absolutely front and center this morning. We literally just saw a sixth consecutive night of U.S. strikes on Iran, and Tehran is already responding by targeting locations including Kuwait. The rhetoric swirling around the Strait of Hormuz is seriously intensifying, and that is directly stoking energy supply fears. I mean, we're seeing Brent crude hanging out right around $85 a barrel. Over on Wall Street, equities took a hit and ended lower. The Nasdaq really underperformed, dragged down heavily by a slump in semiconductor stocks and Alphabet. And you know what's interesting? Gold is actually remaining under pressure. You'd totally expect a massive safe haven bid right now. But those higher oil prices, yeah, they're keeping inflation and interest rate fears very much alive. The reality of the current landscape is pretty stark. It's like they say, diplomacy appears to be taking a back seat, but unfortunately, markets still have a front row seat. Safe havens like gold might occasionally need to take a breather, but make no mistake, the underlying volatility stemming from the Middle East is completely unavoidable for any active trader right now. Moving right along to Section 2, Global Data and today's focus. Okay, we are seeing some massive macro divergence right now, and this perfectly captures it. Over in the US, the data is just relentlessly defying recession calls. Retail sales ticked up 0.2%, and jobless claims just hit a 2-month low. The US labor market is just remarkably resilient. But contrast that with the rest of the globe. South Korea just completely surprised markets with its first rate hike in over 3 years. They're desperately trying to fight inflation while tightening up financial regulations. Meanwhile, the IMF is out here projecting slower growth for Europe all the way through 2027, along with stickier inflation. The policy environment outside the US is just becoming incredibly difficult to navigate. All right, let's pivot into Section 3, Major Currencies Technical View. So the huge fundamental catalyst overnight was this number right here, 5.5%. U.S. headline PPI came in significantly softer than consensus forecasts across the board. Naturally, this softer PPI drove U.S. yields further down, and the dollar fell pretty sharply right along with it. Looking at the technicals, the DXY is currently finding support right at that critical pivot of 100.47. Buying the USD here is actually a really solid setup as a buy with a tight stop ahead of today's upcoming US retail sales data. Now, if that 100.47 pivot breaks, your next floor of support is down at 100.25. And if it drops below that, the whole theme flips entirely to a sell on rise. You've got resistance layered overhead at 100.57 and 100.89. Now, jumping across the pond, the euro is dealing with a serious fundamental drag of its own. Eurozone industrial output actually contracted by 0.2% month-on-month in May. Annually, factory production has plunged a full 1.2%. European yields are remaining sticky because of those high crude prices, but this industrial data creates a massive, heavy anchor for the euro, even despite the overnight pop we saw from that softer US dollar. When you translate that fundamental weakness over to Euro USD, the structure here is strictly a sell on rise. There is simply no momentum support to chase this thing higher. You absolutely have to trade this with tight stops. You've got resistance at 1.1483 and a major pivot point at 1.1508. Honestly, it's only if that 1.1508 level is broken that this chart opens up into any sort of bullish structure. Immediate support rests right below at 1.1447. But hey, the UK is a totally different story. Get a load of this unexpectedly sharp UK retail sales surge, up a full 1.0% month-on-month. When you pair this volume surge with Bank of England chief economist Hugh Pill coming out and stating that UK interest rates might still need to rise this year because their domestic economy is running so hot, you get a massive fundamental tailwind for the pound. And thanks to that fundamental strength, the buy-on-dip strategy has been working like an absolute charm for cable. It finally broke through resistance at 1.3450, which led to a really quick test of the 1.3558 mark. We are definitely maintaining a buy on dips view here. The immediate resistance is 1.3558, and if it holds above this level, the clear upside target is 1.3638. Wrapping things up with Section 4, India markets, focusing on the USDINR and the Nifty. Let's talk about the rupee, because it has been under some intense pressure, dropping down to 96.30. This drop is largely being driven by elevated dollar demand linked to maturing non-deliverable forward contracts. It is down over 1.5% this month alone, which actually makes it one of the absolute worst performers in Asia right now. So for USDINR, the tactical view is firmly buy on dips. As long as the price manages to stay above that key support level at 96.18, the bias is extremely positive, with 96.90 acting as the clear upside target. Now, if 96.18 fails, your secondary support sits further down at 95.82. When it comes to Indian equities, I want you to keep this phrase in mind. Sometimes flat markets hide the busiest conversations. Just look at yesterday. The headline index barely moved an inch. But beneath that calm, flat surface, the underlying internals were incredibly active as investors furiously balanced those resilient domestic fundamentals against all this global geopolitical uncertainty. Case in point, here is the Nifty 50 setup. The index ended practically flat, dropping just 6 little points to close at 24,072. The broader macro view remains buy on dips, but you absolutely must trade with caution today. Your overhead resistance is sitting at 24,344. But the critical line in the sand, the level you have to watch, is support at 23,900. A break below that level is going to open up quite a bit of downside risk. And here is exactly why that flat close was so deceiving. The market surface was highly polarized yesterday. Capital actively fled into defensive and tech spaces. Consumer durables absolutely led the pack, up almost 1.5% right alongside IT and FMCG. Meanwhile, capital completely abandoned higher beta and rate-sensitive sectors, causing some really deep corrections in realty and financial services amid all those geopolitical jitters. And that pretty much wraps up today's brief. We've got massive divergence in global data, geopolitics clearly commanding a front-row seat, and major indices sitting right on the edge of critical pivots. So, the question is, with central banks backed into a corner by sticky inflation and geopolitics threatening all these critical supports, are you going to be a buyer on dips or a seller on rallies today? Plan your trades, trade your plan, and I will see you in the next explainer.